exchange.
So one of the questions I get asked quite often, anybody can be a qualified intermediary.
Anybody, and
But what is, well.
I'm going to show you, touch on that here in a
Okay,
second,
good.
who's qualified, who's not, but yes, that
And what a
does,
scary thought.
we're an unregulated industry. Realtors are regulated, mortgage brokers are regulated, title, everybody in the real estate world is regulated other than a qualified intermediary.
Could we also say
Yeah.
who is your parent company? I think that's important to know.
Yeah. It's coming up here, I'll go over that as part of it, but very important to know who you're working with a qualified intermediary, because you're depositing this right here to the qualified intermediary, a lot of funds. You want to make sure they're there when the time you go to buy that replacement property, okay? And I will, that's a very good thing, that is part of my presentation. So the timelines, this is the other question, people have an idea that they know there's a timeline to the process. Is it 60 days or 45 days to identify or 100 this? They kind of get them all mixed up a little bit. So here it is, the actual answer to that. The timeline starts at close of escrow. So if you're selling your fourplex, August 1st is the closing date, the close of escrow. That's when it's 0, that's when the clock starts. So you got 0 to 45 days to identify. There's 3 different ways to identify, and we'll cover that in a second. But that's where you identify. You don't have to be in contract. You just have to give us an address in writing that these are the properties that I'm looking to purchase and replace into. So that's identification period. So you identify in those 45 days, but you don't have to close on them because you have 180 days to close on one of those properties or more than one of those properties. A lot of people like to hedge their bets and be in contract, or at least the ball rolling in the 45 days before they identify. Especially in a hot market, because if you identify 3 properties, you just pull out the MLS and not talk to that seller. By the time you get to the second week, it could be gone. And whatever you identify is the only ones that you can actually replace into. I'll cover that a little bit more in detail here in a second. So that's the completion period. Counts holidays, everything, 180 days from August 1st on. There's no exceptions, it's 180 right straight through.
It's not 180 and a half days, guys.
No, it's concrete. We're dealing with the IRS. Okay, so delayed exchange continue. You have the identification requirements, like I was just touching on. You have to do it in writing. It has to be signed by the taxpayer, the exchanger, and the identified property, replacement property, and has to go to a qualified person, which I'll cover who the qualified person is. Usually is a qualified intermediary. Okay, so the identification rules. Like I said, there's 3, but 2 of them are rules and 1's an exception. The most popular one is the 3 property rule. Anybody can tell me how many properties you can identify in a 3 property rule?
10.
10. You know how many people I catch on that one? A lot. Yes, 3 is all you can identify in the 3 property rule. This is the most popular one because it doesn't matter what the fair market value of the property is. You identify a $1 million property, a $500,000 property, a $100,000 property. It's just limited to 3. Okay. Now, if you're looking to buy more than 3, the 200% rule is the one that's most commonly used. Now, you don't need to know which is the best property rule for you. We can kind of help you determine that, or your exchanger determine that. But the 200% rule is basically just 2 times the gross sales amount of the selling relinquished property. So if it's a $1 million sales price, you can identify up to $2 million worth of real estate. So, or 10. That'd be $100,000 properties each, up to 10 properties. Or if it's $200,000, you got 5 properties you can identify. You're limited on this one on a dollar amount. This one you're limited on amount of properties. So we can decide either direction on that. And then now the one exception, it doesn't cover this, I think I took that out. But the one exception is basically whatever you identify, say you went over to 200% accidentally, you just basically have to buy 95% of what you identified, which is basically 100% because you can't buy 95% of the last additional property unless it was something you have a partner that is buying the other 5%. So whatever you identify, say you identified 11 properties here at 100,000 on the 200% rule, that just means that you would have to buy 11 of those properties to qualify. Otherwise, you might have some leftover tax money, which is taxable. Okay. So we'll guide you through that process, but these are the 2 most popular ones.
So with the 200% rule, if you sell, if the sales price of your relinquished property is $1 million, you can buy $2 million worth of real estate?
Yes. and identify up to $2 million worth of real estate. But you can actually buy about $3 million if you, or 5, whatever the number is, if you're planning on buying them all. So whatever you identify, you're just going to be purchasing them all. But again, you want to be clear on that because the IRS, the reason why that rule, the exception rule came into place is because some smart guy back in the day would just go and say, well, I'm going to identify anything in this zip code that's on the MLS for sale. So I'm covered on all the properties I want to buy. So one zip code might have hundreds of properties in it. To deter them from doing that, that means that they would have to buy all those 100 properties, so they can't identify that. They're just trying to basically buy time on their identification. So it's a deterrent more, the 100% or 95% exception, the one property. So the 200% is, to answer your question, you would have to purchase or purchase up to that $2 million. Doesn't mean you have to, that just means that you can identify. You could buy only $1 million worth of properties. And the other one,
in terms of the identifying, which
right.
you have to do by the first 45 days.
Right, yeah.
And the same thing with the 3 or you could choose 3 properties.
Right,
And
right.
those properties
You don't have to buy all 3, you could buy a minimum of 1, and that 1 could cover your tax obligation, so you wouldn't have to purchase it. So those are just your options. You just identify the more properties the better, because once you're beyond that 45th day, you can't identify anything else, and you can't buy anything else with those 1031 exchange funds.
We actually identified a short sale against my recommendation last year.
Right.
And the short sale was not approved in
Right.
180 days,
When
and they
came
paid
in plan.
$60,000 in taxes.
Right, yeah.
But that was their choice.
Right, I mean, and that's the thing, that's the hardest thing to fit into the 1031 guidelines, is the identification period. Now, in this class, I'm not going to cover too much about it, but if you're having a hard time at a hot market, like here in Colorado and California, I find those replacement properties are becoming very difficult right now. So there's other things that are out there that you can identify and still qualify for a 1031 exchange. There's DSTs, there's TICs. I don't know if you guys know much about that. That's more of the advanced class.
It's a different type.
It's a different thing, so we can cover that a
Here's
little
what
bit.
happens here. When
Uh-huh.
we first meet with an investor who wants to list a property, we talk to them about what they're gonna do with the money.
Mhm.
And believe it or not, we start looking for replacement property
Right from the
the
get-go.
second they decide to sell.
Right.
Maybe not even when we list. Maybe
Right.
it's a month before we list.
Right.
We go look, we go shopping.
Yeah, hedge your bets, and that's the best way to go. A lot of people think they have to wait until they have, like that August 1st example, that they have to start looking at when the clock starts. No, you want to be almost, you can throw offers and at properties and not going to hurt your tax obligation. You just can't take titleship or ownership of the replacement property, but you
Because then we
can,
go into a reverse.
right, which is again more advanced. And I'll touch real quickly on what a reverse is. A reverse is basically where you're purchasing the property up front before you sell the relinquished property. But you cannot purchase that property because you can't exchange into anything that you own. So qualified intermediary, what we do is we purchase that property under what they call an EAT, and that property is held under an LLC that's created for that sole purpose to buy that property, which means that lenders are not going to lend against it because it's a brand new LLC. So you, the exchanger, have to fund that EAT or that LLC that we create for that property, hold it until you sell your your relinquished property, and becomes reversed, becomes your replacement property. So that relinquished property sells a couple months later, you have 180 days to sell it. Then when those funds you get from there, then you basically exchange into the property that we're holding title to under that LLC. And then that's basically the same steps, reverse.
And do you like doing reverses?
There's a lot more moving components than
Yeah.
reverse exchanges. I just gave you a real generalization on what a reverse is, but there's a lot more things that can happen on those type of exchanges.
To be really honest, IPX is the only company that I know that will do an exchange or a
Reverse
reverse.
exchange, yeah. For IPX, we're a national company which is owned by Fidelity National Finance, a Fortune 300 company, which owns Fidelity Title, Lawyers Title, Chicago Title, Security Title, and Grand Canyon Title, and the list goes on. So we, as far as our reverse division, we're the largest 1031 exchange company in the United States, and our reverse division is right on the same floor I am in Tempe. So that reverse department handles all the reverses across the country. And they're very good at what they do. They do have some lenders that can help. And again, it's more advanced, but there's very limited competition as far as reverse exchanges go for here in this marketplace.
In 20 years, I've only done 2.
Right. They're very popular right now, unfortunately. It's mainly because they found a fourplex or they found a commercial hotel building that they have to have, and they didn't even market their property, but they were waiting for this property to go on sale forever, and now it's on sale. They want to buy it, and they don't want it to go on the market, and they don't want to lose it. So they'll pay, and the fees are higher on a reverse exchange too. So, because there's a lot more reliability that the QI has to take to do that. So if the property's worth it and they're getting a great deal on it, they'll do it, and they'll eat the cost to do it, which is all tax deductible, so that they could get that property they're waiting on. So it's for the most part, it's held in the commercial arena, not so much in the residential side. Okay. So where are we here? So this is just the basics, requirements. Relinquished property and replacement property must be held for, like we were saying, again, for investment purposes and productive use in trade and business. Like kind. Now, like kind, I think I'll go through an example here. These are basically the like kind. Oops, didn't do what I was going to do. Back up. So basically, a lot of people think of like a 1031 exchange as this, the swap, where you got one property worth $500,000, maybe a farm or a ranch, and they got one across the street that's worth about exactly the same, and they just swap deeds and everything works out. Very rarely that happens, that you have an exchange that your relinquished property is the same value as what your replacement property is, and it's like kind. So, but that's, it is possible, and it is something that most people think of. But for the most part, like kind is if you're selling that $1 million property, like kind is that you have to find another property that's not primary residence that's $1 million or greater. Now that $1 million is gross. You can deduct commissions and closing costs. So maybe you might be at $980,000. So to be fully deferred, $20,000 in closing costs, right?
Yeah.
To be fully deferred, your replacement property or properties has to be not equal to $980,000 or greater. Okay. To make things even more complicated, if you have a note or a mortgage on that property, the relinquished property, you have to carry that to the new property as well. So if you have a $500,000 mortgage on that $1 million property, you have to have at least $500,000 or greater on the replacement property. Okay.
Not necessarily the same note, but
No, that's going to be paid off in the prior sale, but you have to get a new note for the same or greater
than what you had in the previous.
Right. So basically what the IRS at 1031 exchange is that whatever you're selling, they want you to go up in the real estate world, or at least the same or greater. So whatever you had before as far as a mortgage, whatever your property was worth before, they want you to go up in value, and your mortgage at least the same.
And there's no.
If you go less, you can still do a 1031 exchange. There's just the difference would be what they call boot, which is taxable. So if they went from a 980 net sale and bought $800,000 worth of property, that difference of $180,000, was that right? 980, yeah. So the $180,000 difference would just be what they call boot, and that portion could be taxable when they file their taxes. But the majority of it would be deferred into the new property. Okay?
Last year, we did an exchange for an attorney out of California, and he wanted to take $20,000 out of the closing to go to Europe. His first thing, I know I'm going to pay tax on that. He understood that.
Yep.
But we exchanged him from a 14-unit into a 9-unit and a condo, 2 properties.
Mm-hmm.
And now I'm trying to talk him into selling
Right.
the 9-unit. We've already sold the condo.
Right. Yeah, I mean, sometimes they're, depending on where they are in their point in their life with their real estate portfolio, sometimes they want to go down and they know they're going to have to pay a portion of that in tax, and they're okay with it. You just want to make sure that the majority of it is going into the new property for them to do a 1031 exchange. If they're going from $1 million to a $200,000 property and the majority of it they're going to cash out, they don't need to do a 1031 exchange because they're going to be paying mostly taxes. All they're going to do is just pay my fee for really no reason. So we advise them on that purposes to do it. We're not in it just to do 1031 exchange if it's not beneficial to the client. So, so for as long as, like, you know, a lot of people, what they initially invested, they want to cash that out when they do that. It could be taxable when they do that because if you're not doing like kind, which is the same value, net sales price or greater. This is just that pie chart again, just so you guys get familiar with it. You got the exchanger, relinquished property, buyer, QI, seller, and this is just the flow. The flow is here. you might have a client, like Linda said, that might be using a different QI from a different state, and then they're buying replacement properties here and working with you, which is great. You can still consult me if you have any questions on it, but the main thing is that you want to ask them if they have an exchange agreement with that company, because some of the smaller companies may not put an exchange agreement together. And basically that exchange agreement is their agreement that the monies are going to be there. It's like the pre-approval letter for a purchaser on a real estate, that the funds are there. So you want to ask if they have an exchange agreement and look at those terms of that exchange agreement if it's from a different company. Because that, when you're looking at replacement properties, that's your verification of funds to buy that property.
And I had a client put their funds with their friend,
Right?
and the friend went to Mexico. Think about that.
Yeah. I'll give you some nightmares in the industry here in a second. So the qualified use, again, is both relinquished property and replacement property must be held for qualified use, which can be either investment property or property held for productive use in trade or business. So this is just going to give you the list of that. Again, no primary residence. That's inventory. And then the improvements of the property. So this was just an intensive action. So the IRS is just going to look at what their intention is of the property and how long they held it. If it is something that they, out of the 2 of the 5 years, it can turn into a primary residence, but you can't do a 1031 exchange and your sole intent is to do a primary residence. So you have to rent it out for those next 2 years to qualify for a 1031 exchange. So they're going to look at what the intent of the taxpayer is. And then again, dealers, property, business, example, these home builders and developers, they don't qualify for 1031 exchanges because they're ordinary income. It's more of a business for them. It's not a 1031 exchange tax or investment held properties. Unless there's an exception, because there's some major developers, builders that bought land here and even in Arizona that sat on it. They were going to build a subdivision on it, but then the market fell out. So they hung on to the land because, you know, they couldn't sell it. And then now they're either decided they want to go for it and develop it or they want to sell it. They would qualify for a 1031 exchange if they held it for like the last 5-6 years, if they were just going to sell it and not develop it. And we had a few of those ones that have happened.
What is the limit for how long you have to own property?
For it to qualify for primary residence, 2 out of the 5 years.
But to do a 1031?
If you're going to purchase another investment property, it doesn't matter because it can be investment property. It's only when you want to convert it to a primary residence. It has to be a rental for 2 years for it to qualify for a primary. So then you can move into it on the 3rd year, and then you'd have to own it or live in it for 2 years to qualify for the 121 tax code. And then you'd have to live in it another additional year because it's 2 out of the 5 that you only occupied it. And then if you sell it in the future, you would fall into those exemptions of $250,000 or $500,000, depending on how you're filing it. You would have to pay your capital gains on it. But again, it's a gray area. Your intention, if you're looking to buy a primary residence with a 1031 exchange funds, your intention is what the IRS looks at. So right out the gate, you want to make sure that it's going to be used for a rental property for at least 2 years.
Perhaps I think maybe what you're asking is that he owns a fourplex, okay?
Right. This is what I'm going to actually cover right here.
Okay,
You might be
never
able to say
mind.
it. Yeah. So this is the law. Before there wasn't a law, we were just kind of like skirting around a little bit to find out what the IRS would accept or not. So the safe harbor laws came in 2008, and this is the Rec Proc that came out, and it kind of spells out exactly what we're just talking about. So here is, you own the property for 2 years before exchanging it. You have to rent it at fair market value for at least 14 days during each year before you could qualify. So you bought another property, you would have to, say you bought it up in Pine Top or Flagstaff, you have to rent it minimum for 14 days a year to qualify for a rental. Okay, but the downside is that you cannot use it. Use it personally for less than 14 days or 10% of the rental period, whichever is more in that calendar year. So you're limited on your use on that property too. But if you rent it out 6 months of the year, and then you could use it for 60 days at 10% rule. So you can use it for 2 months if you rent it out for 6 months. So that's what the IRS has spelled out for us. That's what the safe harbor rules are. There is some gray area there, but you're doing it at your own risk if you're doing anything different than this. Okay, now we touched on this one. So some exchangers will, like my guy that has 52 houses, he wants to maybe change into his dream home instead of buying a commercial property. So if you have, an example, 4 properties, you build up some equity, you want to exchange it into your dream home. This is a way you could do that. Again, you'd have to follow the safe harbor laws and rent it for 14 days a year for 2 years minimum. And then you have to keep your personal use 14 days per year or less, depending, or 10% depending on how much you rent it. Then you can convert it to your primary residence. So now it's your primary residence, but this whole period of time, you still had another primary residence because you sold your rental properties. You're still living in a property for those 2 years, which you're claiming on your taxes as your primary residence. So then now at the 2-year mark, you sell that primary residence, and you do under this 121 tax code, and that way there you can avoid paying any capital gains if it's 500,000 married or 250 single. And then you take that money and you can pay it off down or pay down your dream house mortgage, and you can move into it in your 3rd year. Okay. So the like kind, again, we're touching on that. First to nature, character, the property. So basically it could be anything, oop, that went real quick. It could be anywhere from commercial to land to commercial, as long as it's held for productive investment purposes. Okay, like kind. This is just a list of all the ones that are like kind. And it pretty much it's easier to just remember that it's not your primary residence. So never like kind on 1030 on property held for primary use. Stock, bonds, or notes do not qualify. Securities of evidence of indebtedness. Interest in a partnership. Lawsuits. Any of these things. Foreign property, like you were saying, cannot be outside the U.S. or vice versa. And we're the area manager for New Mexico and Arizona. This comes up quite a bit in New Mexico and some parts down south of Arizona. When you can actually exchange, other than real estate, you can exchange livestock, airplanes, cars, etc. But the biggest thing I threw on here is kind of funny, is because if you have a herd of cows and they're all male, you can't exchange them for all female dairy cow. It has to be like kind. It's very particular when it comes to livestock. And same thing with Bear Jackson. If you go to Bear Jackson, you'll probably see me there, because Bear Jackson, you bought a car for $500,000 or $200,000, you sell it for $1 million. They have to pay capital gains on that difference too, and they can do a 1031 exchange, which we're very popular in helping them out as well. But it's narrowed down on what they could buy as well. So if it's a muscle car, it has to go within the same category as a muscle car. They can't take a muscle car and go buy a Ferrari with exchange funds. It has to stay in the same category. We have specialists under our company that can filter out the details on that, because it is very particular.
So they can't exchange for real estate?
They cannot, no. It has to be like kind, and car for car. It can't be car for real estate. The other thing that's very popular right now here in Arizona, I think I did about half a dozen of them, cell phone towers. They can exchange for real property into a house as long as they own the land that the cell phone tower is sitting in. If it's leased land and it's just the cell phone tower, they can't go into real property. It's personal property at that point, which they could go to a car or like kind, another cell phone tower. They're limited what they can do with that. This has to be real property or personal property. They can have to exchange into those categories. But if they own the land, then they could go to another piece of property. And they've gone up in value. I had a guy that bought cell phone towers 8 years ago, and he owned the land on it, and he bought them for like $100,000 a pop and sold them for $500,000. So he had $1 million, and he wanted to buy a property in Flagstaff and buy a couple properties here in Arizona for rental properties when he sold those 2 cell phone towers. I don't know much about that area, but it seemed like he did pretty good on that. Okay, here's that pie chart again. You got the exchanger, relinquished property, buyer, QI holds the funds, seller to that replacement property in Texas. I'm the QI. Here is what we were talking about, qualified means. Linda kind of threw this one off a little bit on me, but what does qualified mean, according to the IRS? Any guesses on that? Not disqualified. So basically the IRS is pretty black and white. If you're a qualified intermediary, basically who can qualify or who is disqualified actually? The exchanger. You can't do your own exchange because you touch those funds, they're taxable. A relative of the exchanger cannot handle the exchange. An agent of the exchanger. So an agent is anybody, ex-employee, attorney, any one of these listed here that they had business relationships within the last 2 years cannot be the qualified intermediary of those funds. But everybody else is qualified. So like Linda was saying earlier, you could walk down the street, you have your property sold, you got $100,000 worth of gain, you say, hey, do me a favor, can you hold this 100 grand in your bank account for maybe a month or two until I find a replacement property? And you can collect all the interest on it, I don't care, and I'll just give you a call when I'm ready to buy a new property and you just wire that money back to me. You okay? Sure, no problem. 2 months later, he's gone, you may not find him, and then guess what? You don't have your $100,000, and you have to pay capital gains tax on that $100,000 that you don't have. Because the IRS doesn't care if you're stupid or not, they're still going to charge you your taxes on it. Okay, so who can be your qualified intermediary? Like we were saying, anybody, even this clown can be your qualified intermediary. You wouldn't want him to do that. Well, he's in jail right now, so you can't do that. But okay, so here's some horror stories, basically, about qualified intermediaries and bad investments and so on. So you want to make sure who you put your money into it, because failed exchange means that you have to pay taxes on even property that's not there, like I just said, and that could be up to $30,000. So what you want to look for in a qualified intermediary is that you want to look for security funds. Okay. Do they have third-party performance guarantees? A large enough fidelity bond. We have a $100 million fidelity bond on all the funds that go through on our accounts, and we've never had to use it. E&O insurance. We have that. Are their dollar invested into, and are they safe? So some qualified intermediaries will take your funds and actually invest it. So you want to ask that question if they do or not. We do not. Are they secure and will they be around? We're a Fortune 300 company, our parent company, so not to say that's a guarantee, but we're pretty secure as far as that goes. Are they entities or individuals? Like I said, that guy on the street, you want to clarify on who he's backing or if he's just an individual. What's their financial strength? Business practices, are there accounting practices, are they third party or they do them internally? Third party is what we do, so we're in compliance with our investors. Dual signatures on disbursements, basically anything that's deposited in the account goes into the 5 depository banks with us, and it's actually in the exchanger's name, so they will collect interest on those funds. And we can't just take them and go do what we want with them. We need the exchanger's signatures on to move it. And they need our signature on to move it so that they have no control of those funds. As soon as they have control of the funds the exchanger does, they're taxable. So that's why it's set up that way. Written authorization for the exchanger to disperse and exchange funds. And are they complying with the IRS and the safe harbor laws that we talked about those 2 years? And a lot of on the East Coast, attorneys handle a lot of the exchanges of some companies. Even our company, a lot of people in my position are actually attorneys because they use attorneys for the closing on the East Coast instead of escrow and title companies like we do on the West Coast. CES is the only accreditation that we can get as qualified intermediaries. And it's just basically taking a test and seeing how much your knowledge is on it. I'm probably going to do that in the next 6 months or so. Okay, so here's some opportunities to make 1031 exchanges help you grow your business. So you want to have, this is what agents primarily work with, not you guys, but majority of them work with owner-occupied because that's more of their comfort zone. But the non-owner occupied in your county, any guesses on what the percentage of non-owner occupied properties are in Arizona in each county or in your county? Kind of showed there real quick, so I don't know if you caught that number or not. Any guesses on what the percentage?
It was 30% and up, right?
Yeah, 30 to 35%. So here in Arizona, there's a large amount of non-owner occupied properties and on average in each county. So that's a lot. And it might even be growing the last year. I haven't got the number since last year. So opportunities, most people are afraid to go with investors, not you guys though, because that's your business. But investors are a lot easier to work with. And a lot of them in the single family arena are not really that knowledgeable on 1031 exchanges. And a lot of times they find out the hard way. So that's where you can come in to be an expert in that arena. There's thousands of them. Again, average investor owns one rental property, either residential or bare land. The bare land ones, like we were talking before, they can't depreciate land. So it's a good opportunity to exchange from land into single-family properties for rental or commercial or whatever the case is, because now they can depreciate it. Residents, that's not really that there for you guys. Investments.
One of the things that I'll say is because, again, finding